Hello, everyone. Thank you for joining in once again. Today, we've got another very special guest with us as well this morning, Sarah Shaw from 4D Global Infrastructure. We've been supportive of Sarah and also the thematics is quite well aligned with a number of our clients' interests. So I'm really glad to have you here. To give you a bit of a background, Sarah has over 30 years experience across accounting, commercial law, sell and buy side research and also portfolio management, which what you're best at it right now. This also includes 20 years of experience in global infrastructure experience as well. Prior to launching 4D, Sarah worked at AMP Capital, Brookfield, and Rare Infrastructure Fund as well, having both analyst and portfolio management responsibilities. So very pleased to have you here once again.
Thank you very much.
Thank you.
Thanks for having me.
Thank you. So obviously the market's been quite interesting over the last 12 months, to say the least. Our clients will be very keen to hear what are your views in various types of markets. But to start off, I wanted to sort of ask you, what type of characteristics sort of do you look for in infrastructure assets as well? And also, can you take us through a bit of a stock selection process within 4D?
Sure. So look, infrastructure provides the basic services essential for communities to function and for economies to prosper and grow. For us at 4D, this equates to the listed owners and operators of regulated utilities. So your gas, your power, your water utilities, and what we call user pay assets, which are your toll roads, your airports, your ports, and your rail operators. Now, all of these assets have characteristics that we think provide investors with defensive and resilient earning streams. So what are those characteristics? We are looking for monopolistic market positions or ones with very high barriers to entry. We want earnings that are underpinned by contract or regulation. We want sort of like high upfront capital cost, but then very low maintenance spend. So you get all that cash coming out at the end. We want inflation hedges. So as I said, everything that comes together to give you long-term visible earnings that underpin a yield or future growth. So that's what we're looking for from infrastructure. That's what means it is a defensive asset class. That's what investors want from a defensive asset class.
Especially with inflation's becoming one of the concerns.
Exactly, and I think that's a great point because we're sometimes considered to be a bond proxy, but with that inflation hedge, I love inflation. So from an infrastructure investor, I'm hoping
that's the best thing
inflation
that could
comes
happen,
back.
right?
Absolutely.
That's fantastic. And a number of clients actually have been asking for inflation hedges in between, and there are goals and there are a few other things, and even the crypto markets, obviously, they think that's an inflation hedge and it goes in there, but we won't go into that. But
don't understand it.
That's right. We're good at what we're good at, so thank you for sharing that. So from I understand 4D always focused on investing in as well, not just limited but predominantly in emerging markets, and that's an exciting part of it, obviously, because it's projected with a lot of growth going forward. So from what is most appealing to you, I guess, about emerging market infrastructure, and what do you foresee happening in a longer term perspective?
Sure. So look, I think emerging market infrastructure is by far and away the best way to gain exposure to emerging markets. Now, why are we excited about emerging markets? Well, we believe one of the biggest thematics over the next multi-years is the emergence of the middle class, and that's largely in developing economies. So why is that exciting for an infrastructure investor? Well, if you consider how someone's life evolves as their wealth improves, it starts with something like 3 meals a day. Then they move to things, I want indoor plumbing, I want clean water, I want gas for cooking and heating, I want power. That's all infrastructure. Once you have those facilities, you then want white goods like a fridge or a TV. That's more power. And it's also logistics chains, such as port capacity or road capacity. And then over time, your wealth improves and you get a scooter or you get a car and you want roads to drive those vehicles on. So for us, it's just infrastructure is a first beneficiary of the emergence of the middle class, but it's also a driver of the emergence of the middle class, because if you get these facilities in place, that middle class will continue to evolve. So you get access to the true domestic demand story within emerging markets, you get access to the emergence of the middle class, and you hedge some of the key risks to emerging markets. And you mentioned one already, inflation. Inflationary pops we see come through into an emerging markets quite a bit. If I get that access to the growth that's driving the inflation, but I'm hedging the inflation. It's just a perfect storm.
Yeah, I absolutely agree. I think there are a substantial amount of growth that's happening across the board. From a regional perspective, you got some of the Southeast Asian countries as well, and I'm sure the South Americas and things like that. So a very and China was a great example of 10 years ago, 20 years ago, that emerging mid-market class. So
and it's still happening in China.
It is, yeah. It's still they're still classified as emerging market, I think, aren't they?
Yeah.
So it's all beginning of everything. So very, very keen to hear that insight, and thank you for sharing it. I guess, the next part of the question will be just an infrastructure asset in general, as an asset class. What do you think the main drivers of the growth from the listed market space with the infrastructure asset class would be potentially in years to come?
Sure. Look, I think the infrastructure growth thematic is a multi-decade thematic. It's a function of basically a huge need for infrastructure everywhere. And that's a result of aging developed market infrastructure as well as the changing dynamic of the global population, which is driving much needed infrastructure spend. So we see 4 branches to the growth thematic in infrastructure. One is quite simply developed market replacement spend. There's been underinvestment in developed market infrastructure for decades. Now we're talking wooden water pipes still being used in the US.
Wow.
We're seeing 30% of water being lost from leaking pipes. We're seeing bridges collapse. Replacement spend just in the developed markets is a huge investment thematic. Then you move to things like population growth. We've got a global population at the moment about 6.1 billion people. It's supposed to be 11 billion in the turn of the next century.
Wow.
Now, we need to keep that investment just for the population growth. That population growth also creates the dynamic of the emergence of the middle class, which we've just discussed. And then the final bit that really drives from that as well is the energy transition. Now, if we want to sustain this population, if we want to sustain this planet, then we must invest in a greener environment. And to be honest, infrastructure can be part of the problem, but without increased infrastructure investment, we've got no way of reaching a solution to net zero.
And that's actually a very good segment into my next question, because we have been seeing a number of developed markets pledging themselves by 2050 zero carbon emission energy production. There are solar, wind farms being developed everywhere across the world. I don't even know whether that'll be sustainable alone. I think there's some talks about nuclear plants being reintroduced and to potentially fill that gap and so forth. From your perspective as an ESG theme, what are the emerging areas with this carbon neutral theme being pledged by a number of developed countries, and what sort of energy do you think demand that or infrastructure wise would most attract this type of investments?
So I think just as a starting point, when we talk ESG, we need to be very careful that we focus in not only on the E but the S and the G, so they all must marry together. So we like to talk about sustainability, and you can't have sustainability without E, S and G, but focusing in on the E, which is the whole decarbonisation thematic. As I mentioned, you won't get to net zero by 2050 without huge investment in infrastructure. Now, the goal is to have 75% of our energy needs met by electrification. Now, that's a big investment in the electrification of economies. That means we need to get huge investment in renewable energy. We need to get huge investment into the transmission and distribution grids to support that renewable energy. We must electrify transport, so that's roads that can facilitate electric vehicles. And then we've got this gap, which is that 25% that can't be electrified. And if you can't electrify it, then we can't get to net zero. So the alternative there is something that's become a buzzword in the last 12 months, which is green hydrogen.
Green hydrogen, okay.
So green hydrogen is going to account for that 25% that can't be electrified. This is your air transport, your big rail transport, your industrial processes. Now, green hydrogen is not cost effective now. And to actually get green hydrogen viable, we need even more investment in renewable energy, because that's what you need for green hydrogen. So the thematic is decades and decades long. It is huge. I'll use an example of one of our top 10 positions, which is a Spanish company called Iberdrola. Last year, they announced a 75 billion euro 5-year capex plan just in renewable energy transition.
Wow.
Now, 75 billion by 2025 or 26, so 5 years. Now, Australia's got $100 billion infrastructure program. We've got one company doing 75 billion in energy transition, and that just continues to grow and grow and grow. So the thematic is huge. The stimulus programs and the government support is huge, which means that investors can really capitalize on the opportunity.
I guess that's a lot of developed markets can pledge that and do that. From an emerging market perspective, are they then still in need of potentially your coal powers or other aim, because that's much cheaper? They don't have that billions of dollars to invest in infrastructure. What's your view there? Shortly, if you can share that for us.
Yeah, look, we just saw China come out and announce a 2060 plan. I guess. I'm a little bit skeptical of 2050-60 plans because clearly I'm not going to be around to see if they've done it. So it's very easy to throw out a plan. But what we really want to see is that trajectory to get there. So the investment and the plan to actually start decarbonising an economy. Now, somewhere like China, it's not going to be an immediate move from coal to wind and solar and hydro resources. But they have goals for gas, okay? So moving from coal to gas is a step in the right direction. And that's what we want to see in every economy, whether it's an emerging economy or a developed economy, is that real transition planning to get away from the really dirty fossil fuels and at least start to get the economy moving in the right way, or the environmental moving in the right way. So you are absolutely right. There's still going to be a need for, coal's not dead in the next 10 years. And we have China, India, that's close to 3 billion population. They're still going to require
a lot of power,
a resource that's going to be supportive of that economy and the evolution of the middle class. So it's not going anywhere, but seeing them actually move from coal to gas to renewables is a great step forward.
Yeah, that's good to know. Thanks for sharing that insight. But lastly, to wrap things up, obviously last year's been all about COVID, lockdowns, government spending, heaps of money being invested in infrastructure across the globe. Now, on back of COVID, now we're in more of a post-COVID recovery era. What sort of opportunities do you see in that? And is there anything going to be substantially changed in this particular sector afterwards?
Yeah. So look, it was a tough year for everybody in 2020, and infrastructure was not immune to the equity market sell-off. However, we discussed those defensive characteristics, and infrastructure proved that defensive earnings resilience last year, and we saw flat earnings momentum across the sector in 2020. So that's great.
Good outcome.
Okay. And then if you look at any sector in our view that will actually benefit from COVID-19, it's infrastructure. And that comes down to the fact that all of this investment that we've talked about has now been fast-tracked by stimulus programs. So we're going to get it faster. We also see government budgets very stretched, so they can't do this investment themselves, which means they're going to rely on private sector capital like ourselves to do the infrastructure investment. And then finally, if you put the stimulus with the government need, and you've put lower for longer interest rate environments, that just really, really supports the infrastructure operators that can invest for the future. So we actually see COVID-19 as a great push forward for infrastructure. But the fundamental thematic, which we've discussed, is that growth potential of the asset class isn't broken by COVID either. So we have the thematic intact and the COVID response really just driving that forward. And look, the studies show that for every dollar you invest in infrastructure, you're going to get a $3 to $5 economic impact. So you can understand why governments are fast tracking it. So I've never seen a more exciting time to be investing in the listed infrastructure sector. And I just can't wait for the equity market to catch up and join us there on that fundamental.
No, I mean, sometimes if that valuation gap exists, that could be an opportunity for a lot of things. And obviously, as a fund manager, I'm sure you're seeing that on a daily basis. You probably have to resist yourself to buy more rather than anything else right now. So I absolutely agree with you. I think that's a really nice thematic playing into long-term view of the clients and that defensive yield and obviously inflation hedge characteristic is is probably something that attracts a lot of investors to infrastructure markets. So thank you so much for sharing some of the great insights with us, and hopefully we can have you back at Solomons again in the future. We are one of the supporters, and a lot of our clients enjoys utilizing 4D as the infrastructure allocation within the portfolio. So hopefully we can have you back again and share some of these insights again soon.
Thanks very much for your time.
Thank you.